Bloomberg Audio Studios. Podcasts, radio, news.
Investors assessing the market impacts, consumers and businesses already readjusting. Torsten Slok of Apollo writing, this is a wait-and-see economy. Consumers are more reluctant. The bottom line is that this eventually leads to a slowdown in the hard data and markets should prepare for that scenario. Torsten joins us now for more. Torsten, good morning.
Good morning.
We've seen the shift in the soft data. The last time we spoke, you raised the issue. I believe Lisa asked you the question. Would that soft data bleed into the hard data? Do you sense a inevitability now towards that?
We are beginning to see that if you look at the high-frequency data. So over the last several weeks, we have seen, and I know some of these indicators are a little bit special, but we've seen the number of people who are going to movie theaters, number of people going to Broadway shows. If you look at the TSA data for how many people fly in airplanes, even if you look at how many people are visiting the Statue of Liberty here in New York City, all that has actually started to weaken. And now we get another soft data print here at 10 with the Michigan sentiment for consumers. So overall, it is still a little bit too early, but given that we have this wait-and-see situation, both for consumers and for corporates, it does make sense that the soft data should eventually begin to spill over to at least some weakening in the hard data.
One feature of this cycle that I think a lot of people underestimated, you not included, is the resilience of this economy. What is our capacity to absorb shocks now? Has that been reduced?
Well, that's a very important question because that depends on the nature of the shocks. And we're facing two shocks at the moment, namely DOGE, which is laying off government workers. Estimates suggest that there will be around 300,000 workers that might be losing their jobs. Remember that for every federal worker, there are two contractors, according to Brookings. So Brookings studies show that in total, true employment in the federal government is roughly around 9-10 million people. So if you now think about total number of households is 130 million, and someone in a federal worker or contractor lives together with someone in the private sector, you get that as much as 10-15% of all households in some way or another is being impacted from a sentiment perspective by DOGE alone. And tariffs, of course, also in particular impacts anyone who is associated with trade with Canada and Mexico. And you have that is also a particular, of course, across the border to the north and to the south, playing a significant role in a number of states. So the bottom line is not only tariffs and trade war, it's also the combination of the risk that government workers and contractors potentially losing their jobs that are the main reasons why the soft data is weakening the way it is. And it's not only consumer soft data, it's also corporate. If you look at the CapEx planning from the regional feds, Dallas Fed, Philadelphia Fed, New York Fed, that's showing that businesses in those districts are saying we're beginning to cut back CapEx plans. Likewise, NFIB, also roundtable surveys, CapEx planning is also moving lower. So both consumer confidence moving lower, corporate confidence moving lower. It is a precursor for a slowdown coming in the hard data.
There's an argument being made that if what was propping up the United States economy was government spending, it wasn't that strong to begin with. And this is actually somewhat of a withdrawal from a sugar high from an incredible amount of fiscal spend in the direct aftermath of the pandemic. Do you buy that?
There is some truth to the detox argument in the sense that if you look at hiring in non-farm payrolls over the last 2 years, 25% of jobs created in 2023 and 24 were government jobs. The previous years, it was like 5-10%, much less. So a very significant part of jobs in the last 2 years have been coming from the government sector. So it is true that job growth has been slowing in the private sector, even going into these shocks that we're looking at the moment.
Heading into 2025, you were pretty clear that you think that the inflationary shock was going to be maintained and that it was going to create a real problem for the Fed to actually offer a response to that kind of weakness in the economy. Do you continue to see that, even though the shocks that we're seeing right now to policy might have a bigger ramification on growth than you had previously expected?
Well, the real challenge is that going into tariffs, we had that inflation, unfortunately, was still too high at around 3%. And most calculations suggest that you will add roughly half a percentage point to core PCE as a result of tariffs. So it makes a huge difference where you start. If you start with inflation at 3 and you add 0.5%, of course, the risk is that you will have too much upside and we're way above the Fed's target. Whereas if inflation had started at 1.5, which is where we were in 2016, and you add 0.5%, then inflation would move up towards the Fed's target. So the problem was really that the starting point for inflation when these policies came along was that it was unfortunately well above the Fed's target. So the risk is in this situation that you have inflation moving higher and growth slowing down, which of course is the definition of a stagflationary shock.
We were talking to Mohamed El-Erian earlier this week, and he made the point that given these dual shocks, the Fed should probably allow inflation to run a little bit hotter for a longer period of time and address the growth issues and cut rates at least once this year. Do you agree that that's more prudent at a time where there are these stagflationary forces starting to loom?
Absolutely, because the Fed has the dual mandate. On the one side, if growth is slowing, is saying the Fed should be cutting. If inflation is going up, is saying the Fed should be hiking. I think the Fed will look at if growth starts to slow and if we over the next several weeks begin to see that unemployment begins to go up. Let's not forget that non-farm payroll is always done in the week of the 12th, means this week. So this is the week when they do the survey for the employment report. And if we do believe that this week was somewhat intense on the policy front, then there is of course a chance that non-farm payrolls for March could be on the weaker side. And if that's the case, then in the next several weeks, and particularly going into April, and with the April 2nd deadline also from Trump with the reciprocal tariffs, we come to the conclusion that the risk is that we might begin to see growth slow down. And the Fed will say, well, as long as inflation expectations are anchored, yes, actual inflation may be higher, but if inflation expectations are anchored, they will be focusing on growth slowing down. And therefore the risks are that markets will be pricing in more cuts at the time. And by the way, it looks like from stock markets that they are almost saying, well, the Fed should be cutting many more times, whereas rates markets are saying, no, we only need 2 more cuts. So there's almost an inconsistency between the messaging from stocks that are now in correction territory and rates markets saying, no, we only need 2 more cuts.
In the news conference on March 19th, next Wednesday, how does Chairman Powell address those issues? What are you looking for? So
I'm looking very much for how much he's focusing on the soft data slowing down. He did do that at the US MPF last Friday here in New York City, where he was in his prepared remarks saying, everything is generally okay. But when he was sitting down with Anil Kashyap and asked questions, he was more saying, hey, something is going on that has some downside risks that we maybe should be putting more weight on. So I do think that he will begin to talk about, well, there's softness in the soft data, but maybe we also worry about softness in the hard data.
We have seen this incremental shift from the November meeting into December. We don't assume, we don't guess, we don't speculate. Then in December, there was some assumptions, some guessing, some speculation. And then I agree with you. The recent address we had from Chairman Powell, there was another subtle shift. Just started to tackle policy issues head on in a way he hadn't done in the previous few months.
And on some level, he kind of has to, because there is a sort of scenario analysis that has to come from the Fed for them to even be relevant about how they're measuring some of these aspects. And that's probably why the Statement of Economic Projections, which could be a dartboard, but is sort of a messaging tool about how they're going to potentially respond to what is transpiring in policy and how it's transpiring in data, even if it doesn't necessarily come to full pass.
The difference now, I guess, is we're actually getting the policy. They don't have to speculate about it anymore. But that policy comes with a lot of volatility. And Torsten, they've got to manage interest rates through the cycle. Maybe Chairman Powell steps down in the next couple of years. I imagine he will. I don't know for sure, but I think we all think he will. I want to understand from that perspective, you sit there and you acknowledge the risks right now, but also you've got to think about tax cuts, the potential for looser regulation further down the road. How do you manage through the cycle with that in mind?
Well, that's why this debate about is it policy dependent, is it data dependent, becomes really, really important, because of course the policy that's in place suggests that, well, so far the 2 things that we have seen from the beginning is DOGE, which is putting the unemployment rate up, and also tariffs, which is putting inflation up. So if that's the case, they need to deal with that shock as the first thing, even, as you say, if there are other policies coming on deregulation, on lower taxes, and potentially also more energy production.
Torsten, Clinic, as always, good to see you, sir. Looking ahead to next week, March 19th for the Federal Reserve, next Wednesday for that meeting, including a news conference and forecasts from the chairman, Jay Powell. Torsten Slok of Apollo.